Many Americans nearing retirement are making Social Security decisions today without realizing how much those choices can affect their future income. What seems like a simple decision, often completed in less than half an hour, can have lasting financial consequences for the rest of a retiree's life. By the time many people discover they made the wrong choice, the paperwork has already been processed, and the impact on their monthly benefits is permanent. Social Security is the largest and most dependable source of retirement income for millions of Americans. Yet many decisions are made based on advice from friends, neighbors, or assumptions rather than careful planning. Unfortunately, the system does not warn applicants when they are about to make a costly mistake. Once benefits are claimed, the numbers are locked in, and any reduction can continue for decades. In this guide, we'll examine 5 common Social Security mistakes that could cost retirees thousands of dollars in 2026. The first and most expensive mistake is claiming benefits too early without understanding the long-term financial impact. While retirement benefits can begin as early as age 62, claiming early results in a permanent reduction in monthly payments. For someone whose full retirement age is 67, filing at 62 can reduce benefits by approximately 30%. A benefit that would have been $2,000 per month at full retirement age could fall to around $1,400 per month if claimed early. Over a long retirement, that difference can amount to well over $100,000 in lost income. Many people file early because they worry about the future, fear Social Security may change, or simply want to start receiving benefits as soon as possible. While these concerns are understandable, retirement decisions should be based on careful calculations rather than emotions. Before filing, retirees should review their benefit estimates through their Social Security account and compare how different claiming ages affect their long-term income. The next common mistake is one that affects many married couples, failing to consider how a claiming decision can impact a spouse's future benefits. Social Security is not simply a personal benefit. It is often one of the most important financial decisions a married couple will ever make. Your claiming strategy can affect not only your own retirement income but also spousal benefits, survivor benefits, and the long-term financial security of the partner who outlives the other. Unfortunately, many couples approach Social Security as if each spouse is making an independent choice. That misunderstanding can be extremely costly. One of the most overlooked facts is that when one spouse passes away, the surviving spouse generally receives the larger of the 2 Social Security benefits, not both benefits combined. This means the claiming decision made by the higher-earning spouse can have lasting consequences. If that spouse claims benefits early and accepts a permanently reduced monthly payment, the survivor benefit available to the remaining spouse may also be reduced for the rest of their life. Consider a simple example. Suppose a higher-earning spouse is entitled to $2,400 per month at full retirement age. If benefits are claimed at age 62, the monthly payment could be reduced to approximately $1,680 permanently. Years later, if that spouse passes away first, the surviving spouse's benefit may be based on that lower amount. Now imagine the same person waits until age 70 to claim benefits. Delayed retirement credits could increase the monthly payment to nearly $3,000. If the higher-earning spouse later passes away, the survivor benefit available to the remaining spouse would be based on that significantly larger amount. The difference between filing early and waiting could mean more than $1,300 in additional monthly income for the surviving spouse for many years. For married couples, this is one of the strongest reasons to carefully evaluate the timing of a Social Security claim. The decision affects not only your own retirement, but also the financial well-being of the person you love most. Because every situation is unique, factors such as age differences, health conditions, earnings records, and other retirement income sources should all be considered before making a final decision. Mistake number 3 is failing to understand how working while collecting Social Security can affect benefits. Many retirees plan to continue working after they begin receiving Social Security. Some work part-time, others maintain full-time employment, and many operate small businesses or consulting practices. What surprises many of them is the existence of the Social Security earnings test. If you claim benefits before reaching full retirement age and continue earning income from work, Social Security may temporarily withhold part of your benefit if your earnings exceed the annual limit. For those below full retirement age, benefits can be reduced when earnings rise above the established threshold. While different rules apply during the year you reach full retirement age, the earnings test remains in effect until that milestone is reached. The good news is that these withheld benefits are not permanently lost. Once full retirement age is reached, the earnings test ends, and Social Security recalculates benefits to account for months in which payments were withheld. However, during the years before full retirement age, Retirees may receive smaller checks than expected, or even experience temporary suspensions of benefits. Many people are caught off guard when their payments are reduced, because they never realized their continued employment would affect their benefits. The common mistake is assuming that claiming Social Security early while continuing to work is always the best option. In many cases, delaying benefits for a year or two can help avoid the earnings test and potentially increase lifetime retirement income. Before filing for benefits while still employed, review the current earnings limits and carefully evaluate how your work income may affect your Social Security payments. A little planning today can prevent costly surprises tomorrow. If you find these straightforward retirement explanations helpful, consider subscribing to Retirement Watch. Our goal is to simplify Social Security, Medicare, taxes, and retirement planning, so you can make informed decisions with confidence. Staying informed is one of the most effective ways to protect your retirement income and avoid mistakes that could cost thousands of dollars over time. Next, we'll discuss mistake number 4, failing to review, correct, or appeal errors in your Social Security earnings record. Mistake number 4 is failing to review and correct your Social Security earnings record before claiming benefits. Your future Social Security payment is based on your highest 35 years of earnings. If even 1 year is missing, reported incorrectly, or credited to the wrong record, your monthly benefit could be lower than it should be for the rest of your retirement. What many people do not realize is that the responsibility for identifying and correcting these errors falls on them. Most Americans never take the time to review their earnings history. They assume every employer reported wages accurately, every form was processed correctly, and every year of work appears exactly as it should. In many cases, that assumption is correct, but not always. Mistakes happen more often than people think. Businesses close, records disappear, paperwork is misplaced, names are misspelled, and Social Security numbers can be entered incorrectly. Sometimes wages earned decades ago are recorded under a slightly different name and never linked to the correct account. Even a small error can affect benefit calculations for years to come. Fortunately, checking your earnings record is relatively simple. By creating a free online Social Security account, you can review your complete earnings history and verify that every year of employment has been recorded accurately. As you review the record, pay close attention to missing years, unusually low earnings amounts, or anything that seems inconsistent with what you actually earned. If you discover an error, it can often be corrected, but supporting documentation is essential. Old W-2 forms, tax returns, pay stubs, and employment records can help prove your earnings. The challenge is that the longer an error remains undiscovered, the more difficult it can become to fix. Some corrections may even be subject to time limits. That is why reviewing your earnings history well before filing for benefits is so important. Many retirees who carefully examine their records uncover mistakes that, once corrected, increase their monthly benefit for the rest of their lives. Those who never check may never realize how much income they could be missing. Now let's move to mistake number 5, one of the least discussed retirement mistakes, yet one that can quietly cost retirees thousands of dollars every year. Mistake number 5 is overlooking how Social Security interacts with taxes and Medicare. Many retirees think of Social Security, taxes, and Medicare as separate parts of retirement planning. In reality, they are closely connected, and decisions involving one area can have significant consequences in the others. One surprise for many retirees is that Social Security benefits may be taxable. Depending on your overall income, as much as 85% of your Social Security benefits can be subject to federal income tax. The calculation is based on what is known as combined income, which includes adjusted gross income, tax-exempt interest, and a portion of your Social Security benefits. As combined income rises, a larger percentage of Social Security benefits may become taxable. Many retirees discover this only after filing their first tax return following retirement, when they are faced with a larger tax bill than expected. Medicare adds another layer of complexity. Premiums for Medicare Part B and Part 500 are tied to income through a program known as the Income-Related Monthly Adjustment Amount, commonly called IRMAA. If your income exceeds certain thresholds, Medicare premiums can increase significantly. What catches many retirees off guard is that Medicare uses income information from 2 years earlier. A large withdrawal from a traditional IRA, a Roth conversion, the sale of investments, or other major financial transactions can result in higher Medicare premiums years later. At the same time, those same transactions may increase the taxable portion of your Social Security benefits. The mistake many retirees make is viewing these financial decisions independently. They claim Social Security, withdraw retirement funds, or sell assets without realizing how each action affects taxes, Medicare costs, and future cash flow. When retirement income decisions are coordinated properly, the results can be remarkably different. Strategic planning can reduce taxes, avoid unnecessary Medicare surcharges, and help preserve more retirement income. Poor planning, on the other hand, can create a chain reaction of unexpected expenses. For this reason, many retirees benefit from consulting a qualified tax professional or retirement planner before making major financial moves. A knowledgeable advisor can evaluate all income sources together, identify potential tax consequences, and help create a withdrawal strategy that minimizes long-term costs. Before claiming Social Security, converting retirement accounts, or selling major assets, take time to understand how those decisions may affect both your taxes and Medicare premiums, not just this year, but for years to come. The retirees who take time to plan ahead often keep more of the money they worked so hard to earn. Those who make retirement decisions one step at a time, without considering the bigger picture, frequently end up paying more in taxes, Medicare costs, or reduced benefits than necessary. Let's bring everything together with a simple retirement checklist you can start using today, no matter where you are on your retirement journey. Asterisk, asterisk, first asterisk, asterisk. Before claiming Social Security, review your benefit estimates at different ages. Compare what your monthly benefit would be if you file at age 62, at your full retirement age, and at age 70. Understanding the long-term impact of claiming early versus waiting can help you make a more informed decision. Asterisk, asterisk, second, asterisk, asterisk. If you are married, discuss your claiming strategy as a team. Your Social Security decision affects more than your own benefit. It can influence spousal benefits, survivor benefits, and the financial security of the spouse who may live longer. A thoughtful conversation today can have consequences that last for decades. Asterisk, asterisk, third asterisk, asterisk. If you expect to continue working after claiming benefits, make sure you understand how employment income may affect your Social Security payments before reaching full retirement age. Knowing the earnings limits and related rules can help you avoid unpleasant surprises. Asterisk, asterisk, fourth asterisk, asterisk. Carefully review your Social Security earnings history. Check for missing years, unusually low earnings, or other discrepancies. Correcting errors before filing can increase your future benefits and prevent problems later on. Asterisk, asterisk, fifth asterisk. Asterisk. Before making major retirement income decisions, such as claiming Social Security, withdrawing large amounts from retirement accounts, converting traditional retirement funds to Roth accounts, or selling significant assets, consider speaking with a qualified retirement or tax professional. The interaction between taxes, Medicare premiums, and Social Security benefits can have a major impact on your long-term financial picture. These are not secret strategies or complicated loopholes. They are simply important rules built into the retirement system. People who understand them are often able to preserve more of their retirement income, while those who overlook them may unknowingly leave money on the table. Before we finish, an important reminder: this content is provided for educational purposes only. It should not be considered financial, legal, tax, Medicare, medical, or Social Security advice. Retirement rules, benefit amounts, income thresholds, and regulations can change over time, and every individual's situation is unique. Always verify information through official government resources and consult qualified professionals before making significant financial decisions. If you have stayed with us through this entire discussion, you have already taken an important step that many people never take. You invested time in learning. The individuals who make successful retirement decisions are rarely the ones chasing shortcuts. They are the ones who slow down, ask questions, understand the rules, and make decisions carefully. That habit alone can make a tremendous difference. A well-planned retirement is often built not on financial tricks, but on informed choices made at the right time. If you found this information valuable, consider subscribing to Retirement Watch and enabling notifications. We publish new videos each week covering Social Security, Medicare, taxes, and retirement planning in clear, easy-to-understand language designed to help you make confident decisions. You can also help someone you care about by sharing this video. A spouse, parent, sibling, friend, or neighbor may benefit from information that could help them avoid costly mistakes and protect more of their retirement income. Before you leave, we'd love to hear from you. Which of these 5 Social Security mistakes surprised you the most? Asterisk, claiming benefits too early. Asterisk, overlooking the impact on a spouse. Asterisk, not understanding the earnings test. Asterisk, failing to review earnings records. Asterisk, ignoring the connection between Social Security, taxes, and Medicare. Your feedback helps shape future videos and allows us to focus on the topics that matter most to retirees. Thank you for watching. Take care of yourself, take care of those you love, and we look forward to seeing you again in the next Retirement Watch video.